Here's what happens. When you invest $15,000 in the 4 best Fidelity Index funds, 2 people put $15,000 into the exact same 4 Fidelity Index funds on the exact same day. 30 years later, one of them has an account worth around $870,000. The other has just over $500,000. Same money in, same 4 funds. Nothing exotic, no stock picking, no timing the market. And yet one account is nearly 70% bigger than the other. Here's the part that'll really get you though. The person with the smaller account is collecting about 10 times more cash every single month. So which one would you actually pick? By the end of this, you'll know exactly which 4 funds we're talking about, how to split the 15 grand between them, and what the real 10, 20, and 30-year numbers look like. Quick note before we go further, this is education, not financial advice. You're an adult, you make your own calls. So here's how we're going to break this down. First, why 4 funds and not 1 or 10? Then the 4 funds themselves, one at a time, then the 2 different ways to build the portfolio, same ingredients, different recipe, and finally the projections and the one trade-off that decides everything. Let's start with why 4. A portfolio isn't a pile of funds you like. It's a set of jobs that need doing. And there are really only 4. You need an anchor, a broad slice of the whole US market that just quietly does what the economy does. You need a growth engine, something built to outpace the average because the average is fine, but it isn't exciting. You need international exposure because no single country wins every decade. And betting your entire future on one flag is a bet, whether you call it that or not. And you need income, cash that shows up in your account whether the market is green, red, or flat. Now, if the word index fund still feels fuzzy, here's the whole thing in one breath. An index fund is a basket of stocks that follows a rule instead of a manager's opinion. The rule might be own every company in the US market or own everything on the NASDAQ. Nobody's sitting there picking winners and charging you for the privilege. The fund just follows the list. And that matters more than it sounds, because the fees are tiny, and over 30 years, a fee that looks like a rounding error quietly eats a real chunk of your money. Small drag, long time, big hole. So low cost isn't a nice to have here, it's the whole point. Let me show you which 4 Fidelity funds handle each job. Let's start with the foundation. The first fund is FSKAX, Fidelity's Total Market Index. This is your anchor. One fund, and you own roughly 3,700 US companies. Not just the giants everyone knows, but the mid-sized and small companies too. That's the quiet advantage over an S&P 500 only fund. The S&P gives you the 500 biggest names, but FSKAX gives you the whole board, top to bottom. And here's the elegant part. It manages itself. When a company grows, it automatically takes up a bigger slice of the fund. You don't rebalance, you don't trade, you don't do anything. The winners rise, the laggards shrink, and you just hold. The expense ratio is 15 thousandths of 1%, 0.015, which is about as close to free as investing gets. It holds around $138 billion, and over the last 10 years, it's returned about 15.1% a year. Now, if the first fund is your anchor, this next one is your engine. FNCMX tracks the NASDAQ Composite, around 3,000 companies listed on the NASDAQ exchange. And let's clear up a common mix-up. The NASDAQ isn't a fund, it's an exchange, a place where stocks trade. This fund just owns the companies listed there, which happens to be tech-heavy. Apple, Microsoft, Nvidia, Amazon, Meta. Here's the thing though, and I want to be fair about it. This fund is concentrated. The top 10 holdings make up nearly 60% of the whole thing, and Nvidia alone is around 11%. So when tech soars, this is your best performer, about 17.95% a year over the last decade, the highest of the four. But when tech breaks, it breaks hard. During the dot-com crash, the NASDAQ dropped more than 70%. That's the deal you're signing. Highest returns, highest stomach drop. The expense ratio is 0.30%, higher than the others, but still low by any normal standard. Here's the one most people skip, and it's a mistake. FTIHX is Fidelity's total international index, more than 5,000 stocks across developed and emerging markets. The top holdings are names a lot of Americans have never heard of. TSMC, Nestle, Novo Nordisk, ASML, even though several of them are among the most important companies on the planet. Now, let me address the objection you're already forming, because it's a good one. International has underperformed US stocks for a decade, so why bother? Fair. But here's how it actually works. The 2000s tell the whole story. US stocks went basically sideways for 10 years while international markets moved. Leadership rotates. It always has. Nobody rings a bell when it flips, and by the time it's obvious, you've missed the turn. There's a bonus here too. This fund's dividend growth rate has actually been higher than the US funds, around 17% over 5 years, with a yield of about 2.54%, all for an expense ratio of 0.06%. You're not holding it because it won last decade. You're holding it because you don't know who wins the next one. Last fund. This one does something the other three don't. It pays you. FDVV is Fidelity's high dividend ETF, built around large and mid-cap US companies that hand cash back to shareholders. And here's the surprise. The top holdings include Nvidia, Apple, and Microsoft. The same tech giants people think of as pure growth are now paying enormous dividends, simply because they've gotten so big. This is your income engine. Nothing magical about dividends, they're just cash flow, real money landing in your account regardless of what the share price did that week. The quiet superpower is dividend growth. As these companies raise their payouts year after year, your yield on what you originally paid keeps climbing. FDVV yields around 2.8% today, has grown its dividend more than 10% a year over 5 years, and the share price itself has appreciated around 9% annually. Income and growth in one holding. The expense ratio is 0.15%. Picking the funds is step 1. Here's step 2, and it matters way more. Because once you've got the 4, the whole strategy comes down to weighting. How much of your 15 grand goes where? Same 4 funds can produce completely different lives depending on the split. Let me show you 2 builds. The first is the growth portfolio. The goal here is simple. Maximize the total account value over 30 years and don't worry much about income along the way. So you lean hard into the US market and the growth engine. 55% goes to FSKAX, that's $8,250. 25% to FNCMX, $3,750. 10% to international, $1,500. And 10% to dividends, another $1,500. Almost all of your return comes from price appreciation. The dividends are an afterthought. Blended out, that mix has historically returned around 14.5% a year. Now let's flip the weights and see what happens. This is the income portfolio, and the goal is different. Maximize the monthly cash flow, not the size of the account. So the dividend and international funds get the boost. 40% stays in FSKAX, $6,000. 15% in FNCMX, $2,250. But now 25% goes international, $37.50, and 20% into dividends, $3,000. Blended, that's around 12.8% a year, a bit lower. And I want to be clear, lower total return doesn't mean worse. It's a different objective. One build is optimizing for the biggest number on the screen. The other is optimizing for the biggest check in the mailbox. Those aren't the same goal, and pretending they are is how people end up disappointed with a perfectly good plan. Before I show you what this actually turns into, if this is useful to you, take a second and subscribe. Because this is exactly the kind of thing I break down here. And if you want the version of this for a smaller starting amount, I did a whole video on $10,000 across 3 funds. It's a good companion to this one. Check it out after. All right, let's run the numbers. Start with the growth build. After 10 years, your $15,000 is around $58,000. After 20, roughly $225,000. And after 30 years, about $870,000. Enormous. But here's the catch. The monthly dividend. Income coming off that account at year 30 is only about $140. A near $1 million account, and it hands you $140 a month. Massive account, tiny paycheck. Now the income build. 10 years in, about $50,000. 20 years, roughly $167,000. 30 years, around $510,000, meaningfully smaller than the growth account. But the monthly income at year 30? More than $1,400. That's the dividend snowball taking over. Roughly a third of that total growth came from reinvested dividends compounding quietly in the background, the part that doesn't show up early, because compounding always hides at the start and then shows up all at once near the end. So sit with the contrast. The smaller account pays you 10 times more per month. That's not a mistake. That's the trade-off, working exactly as designed. So now you've got 2 strategies, same money, same funds, very different outcomes. Here's what that actually means. The obvious objection is a good one. You could just take the growth account and pull 4% a year, the standard safe withdrawal rate, and that's about $34,800 annually, way more than the income build's payout. So why would anyone pick income? One reason, sequence of returns, risk. Here's the plain English version. If you're selling shares to fund your life and the market crashes right as you retire, you're forced to sell more shares at low prices to raise the same cash, and those sold shares can never recover with the market. You lock the loss in permanently. That's the quiet danger inside the 4% rule. The income portfolio sidesteps it entirely because you never sell. The dividends just arrive. The market can drop 40% and your monthly check barely notices because you're living off the cash the companies pay you, not off shares you're forced to liquidate. That's why dividend investors tend to sleep better in a downturn. Neither one is right or wrong. They're 2 different bets. If it were my money, I'd lean toward the income side as I got closer to actually needing the cash. Precisely because I'd rather not have my retirement depend on the market's mood the year I stop working. But that's a preference, not a rule, and reasonable people land the other way. Bottom line, $15,000 today, 4 boring index funds and 30 years of leaving it alone turns into somewhere between $500,000 and nearly $900,000, the only real variable being which job you asked your money to do. The one move that doesn't work is waiting, because the whole engine here is time, and that's the one input you can't buy more of later. So if you want to see how this same idea plays out, even if you're starting later with nothing saved, Watch this next one. This 3-fund Fidelity plan can still get you to $1 million at 38 with nothing. Subscribe if this helped, and I'll see you in that one.